Welcome to Breaking News to Trading Moves. Welcome to the debate. Imagine this scenario for a moment. You find a trading strategy with an 80% win rate.
Which, that feels like printing money, right?
Exactly. It feels flawless. Every single week, the account balance ticks up. But then, exactly 6 months later, your balance sits at absolute zero.
Yeah, it is the classic quantitative paradox. How exactly does a mathematically winning system bankrupt you?
Right, and that paradox gets right to the core of systematic and algorithmic trading. Today, we are exploring a tension that really sits at the center of market survival.
The main question being, what is the primary determinant of long-term profitability?
Yes. Is it the structural, mathematical edge of the strategy itself? Meaning, its expectancy, its payoff distribution, and how it actually aligns with market behavior?
Or, on the other hand, is it the rigorous application of capital allocation and strict position sizing?
Precisely. And I argue that structural expectancy and understanding your system's payoff distribution, that has to serve as the absolute primary driver of success. Your mathematical advantage, it just has to be engineered first.
And I look at this from an entirely different angle. Strict capital allocation dictates survival. That renders even the most pristine mathematical strategy completely useless if your sizing rules are ignored.
Well, let me explain why the structural mechanics really must be the foundation here. A trader's ultimate viability depends on mathematical expectancy, right? And how perfectly the strategy aligns with the market.
Sure, but
There is this terrible psychological trap out there where market participants rely on a high win rate, say 60% or that 80% we just imagined. But a high win rate is just a mathematical illusion if your reward-to-risk ratio is inverted.
the classic negative skew.
Right. If you are risking $300 to make $100, an 80% win rate will just slowly bleed you dry over time. Success requires a really comprehensive understanding of 3 distinct layers of a strategy.
Okay, lay them out.
First, the distribution. We mean defining exactly what your average win looks like versus your average loss, and, understanding the extremity of your outliers. Second, the failure mode.
Meaning when the system falls apart.
Exactly. Understanding exactly how the system breaks under volatility expansions or tail events. And third, specific market conditions. If you rely on a metric like win rate without context, you are walking towards zero, no matter how carefully you manage your bankroll.
I hear you on the math, I really do, but honestly, that is just living in a spreadsheet. Expectancy is entirely theoretical if you do not survive long enough to realize it.
But the expectancy is the engine.
The quantitative literature is filled with backtests showing positive expectancy. But those models, they often ignore the true math of ruin. The statistical reality is that even with a proven advantage and a 50 or 60% win rate, an extended losing streak is inevitable.
Well, streaks happen, yes.
Right, such as 13 consecutive losses. That is a mathematical inevitability over a large enough sample size. If you risk too much per trade, that inevitable streak wipes you out before the math ever, plays out in your favor.
But if the sizing is right,
That is my point. Position management, utilizing logic derived from the Kelly criterion, never going all in, risking only 0.5% to 1% of capital per trade, that is the only threshold separating gamblers from professionals. The math of ruin is absolute.
you brought up the psychological trap of drawdowns, and that leads exactly into why I focus on structural design over defensive sizing alone. The public obsession with win rate obscures what actually builds wealth.
Which you would argue is expectancy.
Positive expectancy combined with R multiples. Yes, let us clarify that concept for a second. When we talk about R multiples, we define exactly how many units of risk you earn on a trade relative to what you put on the line.
Right, the reward multiplier.
Consider a strategy with only a 40% win rate, but a 1-to-3 risk-to-reward ratio. That means you are risking 1 unit to make 3. You are losing the majority of your trades. But mathematically, that creates a highly robust, profitable system.
On paper, yes.
The advantage is in the payout structure, not the frequency of wins, When the payout structure is correctly aligned, the drawdowns, well, they take care of themselves because the large wins consistently outpace the small losses. You generate forward momentum precisely because the internal mechanics are sound.
That is a compelling theory. But let us talk about the sequence risk of actually executing a 40% win rate in live markets.
Okay.
Even with a 1-to-3 ratio, human emotion and the unpredictability of sequence will break the trader without rigid, predefined sizing. Think about flipping a biased coin that lands on heads 60% of the time.
You have a clear advantage there.
You do. But if you bet half your net worth on every single flip, a perfectly normal sequence of 3 tails in a row bankrupts you. That is sequence risk. Let us frame the asymmetry of loss here.
The recovery math.
Exactly. If you hit a drawdown and lose 50% of your account, you do not need 50% to get back to break even. You need 100%. That asymmetrical punishment is exactly why position sizing must dictate every action.
Well,
A 10-trade losing streak means nothing on a paper account. But with live capital, if you risk 5% per trade, a 10-trade streak puts you in a 50% drawdown. Most people cannot psychologically recover from that. They start revenge trading to make it back quickly.
Oh, for sure. If you are listening to this and you have ever revenge traded after 3 stopouts in a row, you know exactly how brutal sequence risk can be. But I would frame the solution differently.
How so?
Think of a casino. The casino holds a structural, mathematical advantage at the blackjack table. That advantage is their engine. It is mathematically engineered into the rules of the game itself.
They also have table limits.
Yes, they have table limits to manage sequence risk. But without the built-in mathematical edge of the game itself, those table limits just mean the casino bleeds money slowly instead of quickly.
I mean, that is true, but
even random entries with tight risk controls will eventually lose to transaction costs and the bid-ask spread. The structural edge is what actually pays you. You can have all the defensive capital allocation rules in the world, but if the strategy's inherent expectancy is a dud, you are not moving forward.
I just do not buy that you can separate the two and prioritize the engine. To use your own casino metaphor, if the casino let a billionaire walk in and bet $1 billion on a single hand of blackjack, the casino could go bankrupt tonight despite their mathematical advantage.
Because they exceeded the optimal Kelly fraction.
Exactly. Risk limits are what allow the law of large numbers to activate at all. Professional fund managers do not swing for the fences. They survive. They use fixed fractional risk. It gives them a buffer of 50 trades before they even approach a severe drawdown limit.
Because their capital is massive, sure.
The math works on paper, but emotions break the math in real life. If you feel your heart racing when you execute an entry, your position is too large. It does not matter how perfectly engineered the mechanics are if the allocation forces you to panic and close the trade before the probability plays out.
Then let us apply this directly to the quantitative data comparing momentum and mean reversion strategies, because this perfectly illustrates why aligning your strategy to the market behavior is the actual safety net here.
All right, let us look at the data.
We have data analyzing assets like Tesla and gold over an 11-year period. Momentum strategies capitalize on volatile, trending assets. Mechanically, they create fat right tails, meaning outlier large winners, and thin left tails, which are controlled small losses.
And mean reversion is the opposite.
Right. Mean reversion, on the other hand, assumes prices return to a historical average. Why does mean reversion create fat left tails? Because you are constantly stepping in front of a moving freight train assuming it will stop.
Yeah, fighting the trend.
When you are wrong and a new trend establishes, your loss just keeps running because there is no natural ceiling to the price movement.
Exactly.
So the data shows Tesla performed terribly under a mean reversion strategy. The prices did not regress well to the average, and the speed of regression was erratic.
Which makes sense for a growth stock.
Right. So if you do not structurally align your strategy to the asset-specific behavior, your position sizing will not save you from a flawed model. You will just take a series of perfectly sized, continuous losses until you are out of capital. Asset selection and strategy alignment are what actually protect the account.
See, I disagree. The failure of mean reversion in certain assets exactly proves the necessity of risk management. Because mean reversion has fat left tails, A strict capital limit is the only safety net when the assumed market model breaks.
But you should not be using that model on that asset anyway.
But assets alter their behavior constantly. Tesla's volatility profile evolved drastically over that 11-year period. A stock that historically reverted to the mean can suddenly enter a prolonged, aggressive trend.
True.
Let us say your system buys when a stock drops below its historical band. News hits. The stock drops 10%, you buy. It drops another 10%, your system says the reversion probability is higher now, so you buy more.
A martingale approach, yeah.
Without an ironclad sizing rule that cuts the total exposure, a mean reversion failure destroys the account entirely. The strategy structure is fragile, the capital allocation is the armor. If you look at the distribution of mean reversion systems, they are not normal distributions.
No, they are heavily skewed.
That fat left tail means extreme outliers exist. You have to cap them mechanically, regardless of what the structural backtest says.
I disagree with that conclusion because you are treating capital allocation purely as a defensive mechanism. And in doing so, you risk neutralizing the strategy altogether.
Neutralizing it? How?
If you rigidly cap risk to survive the left tail, do you not also artificially cap the fat right tails that make momentum trading profitable in the first place?
Well,
Think about the mechanics of momentum. It relies on letting profits run to capture those massive outlier moves. If you are mechanically cutting size or flattening positions based on strict, static risk limits because you hit an arbitrary profit target, you strangle the mathematical advantage.
but you don't have to use static profit targets.
If you are cutting off the right tail, you are ruining the edge. You need the distribution to play out. You need the room to let the asset trend to realize the positive expectancy.
You do not strangle the advantage if you use an anti-martingale approach or trail your stops correctly based on volatility. Capital allocation is not just about limiting losses, it is about asymmetric exposure.
Okay, explain your framing there.
You start with a small, predefined risk, say 1% of your total equity. If the momentum trade catches that fat right tail, the position grows in equity. You manage the risk by trailing your stop behind the trend. But the initial risk was still strictly defined and limited.
So the exposure scales dynamically.
Yes. You protect the initial capital while allowing the market to dictate the upside. You never need a massive initial position to benefit from a fat right tail. In fact, if you look at the Tesla momentum data you reference, the parameters of the strategy completely change the outcome.
Right. The look-back windows.
Exactly. Changing the historical look-back period from a one-day window to a 60-day window improved the Sharpe ratio from negative 5.21 to positive 1.28.
Well, sure, because the 60-day window captures the actual structural trend rather than the daily noise.
Right. The strategy parameters matter. I am not denying that. But they only matter if you survive the inflection points where the trend breaks.
Mm-hmm.
If the asset alters its behavior and chops sideways for 6 months, the momentum strategy's performance plummets. Your predefined risk limits are what keep you alive during those inflection periods until the 60-day trend reestablishes itself.
And that brings us to a crucial aspect of system design: engineering your failure modes. A strategy is not just a set of entry and exit rules, it is a comprehensive understanding of when those exact rules stop working.
Which is hard to quantify in real time.
But you have to. You have to know how the system breaks, whether it breaks when volatility expands, when trends transition to sideways chop, or, during massive gap downs.
How do you practically do that without hindsight?
You do this by tracking specific setups and logging R multiples across different conditions. For example, a trader might systematically tag every trade with a setup name like opening range breakout or VWAP reclaim.
Okay.
A trader might look at their account, see they are up $3,000 over 200 trades, and assume their edge is solid. But when they analyze the structural data, they might find the opening range breakout made $8,000 and the VWAP reclaim lost $5,000.
Which is a classic data analysis trap.
It is structural design. It tells you exactly what to kill and what to scale. You eliminate the setups with negative expectancy after a sufficient sample size, say 30 trades. If you do not know your failure mode, you do not actually understand your strategy.
It is just optimizing the past, though.
You are flying blind, just hoping your seatbelt saves you during the crash. Tracking behavior by conditions, volatility environments, session times, regime filters, gives you necessary context. If you just look at a win rate without context, you are staring at a scoreboard instead of understanding the mechanics of the game. Yes, markets are complex, but structural design allows you to actively adapt.
Logging failure modes sounds highly scientific, but it relies heavily on historical backtesting. And backtesting is notorious for curve fitting.
If you over-optimize, sure.
You are optimizing past data to find out when the system failed historically. But the future will never perfectly repeat the past. Financial markets are complex and non-stationary. Therefore, the ultimate protection against unknown future failure modes is not better data analysis.
What is it then? Just shrinking your size?
It is maintaining fractional risk limits. The Kelly criterion applied practically means you divide your capital into small, equal fractions. You treat every single trade as an independent event with a maximum loss threshold.
But that is so passive.
It is protective. That way, no single unforeseen failure mode, something completely outside your historical data, can cause total ruin.
But if you just constantly default to small sizing to protect against the unknown, you are ignoring the mechanics of why markets move. The quantitative data shows us that different assets require structurally different approaches.
I am not disputing that.
You cannot trade gold the same way you trade Tesla. Gold might require a mean reversion structural approach during certain macroeconomic environments, while Tesla demands a momentum approach. If you apply the same static risk model to both without understanding the underlying distribution, your capital allocation is just a slow march to zero. You must actively engineer the advantage.
I am not arguing against structural design here. I am saying that structural design is inherently fragile precisely because of the data mining trap.
It is only a trap if you do not understand the underlying logic.
You can filter the historical data until it looks perfect on a chart. You can remove the VWAP reclaim trades and tell yourself your system is infallible. But a 13-trade losing streak is statistically expected in live markets, even with a highly robust system.
True.
When that happens, your detailed analysis of volatility environments will not comfort you. The only thing that will keep you from abandoning the strategy is knowing you only risked 0.5% per trade, and your total account is only down 6.5%.
The psychological buffer.
Exactly. The Kelly formula is not omnipotent, but it helps you avoid the most fatal risks in trading, greed and impulsiveness. Investing is not about who makes the most money during a bull run. It is about who survives the longest across all market environments.
While we have covered a vast amount of ground regarding the mechanics of systematic trading, let us summarize where we stand.
Sounds good.
My position is that long-term viability requires a mathematically sound edge, positive expectancy, and a deep understanding of a system's payoff distribution and structural failure modes. You must engineer the advantage first, or the market will inevitably consume your capital through friction and variance. Relying purely on defense without a structural weapon means you are just surviving until you slowly bleed out.
And my perspective is that mathematical edges are inherently fragile and always subject to sequence risk. Survival relies primarily on capital preservation and position management to weather the inevitable drawdowns. The math of ruin takes precedence over the math of expectancy because, no matter how perfectly engineered your system is, you cannot compound to zero.
We do agree explicitly that focusing purely on win rate is a universally poor metric for trading success. A 60% or even 80% win rate is a dangerous illusion if the underlying reward to risk dynamics are flawed.
Absolutely. The win rate tells you almost nothing about longevity without the context of position sizing and the average loss. Combining strict structural strategy design with ironclad capital allocation is the ideal state, but you must respect the math of ruin first. If you lose the capital, the game ends.
It leaves us considering which pillar to prioritize when entering the market. Do you obsess over the theoretical probability and the structural distribution, ensuring your mathematical advantage is flawless?
Or do you build the defensive parameters first, assuming that extreme market events will eventually break your models?
Both are required for longevity, but one must form the foundation of your philosophy. We will leave it to you to determine which pillar you must prioritize first in your own market approach.